I think the economy and stocks have been suppressed for the past few years. Part of it is, of course, that we've seen 6 what I call extinction events take place in markets, everything from COVID to the bullwhip supply chain effect as the economy restarted, to the fastest inflation cycle in history, and then followed by the fastest Fed hikes in history. And then we've, of course, had a very controversial administration which put tariffs in place in April of this year that caused a miniature bear market. And then we've even had the U.S. bombing Iran's nuclear facilities. I think all of these collectively have made investors very nervous about what I call investing in full risk, because these are what 6 black swans that happened in 4 years. And I think on top of that, we've had a Fed has not really given a green light about monetary easing, and I think the Fed's reluctance has actually suppressed business, quote, animal spirits, because the ISM has been below 50 for more than 3 years now. So I think that's all been a business cycle that has been pretty good, but not one that has been really expansionary, and I think that starts to happen next year. Yeah, I mean, I think 2026 is going to look a lot like this year, meaning we are probably going to have many months where the market is actually down year to date. I mean, this year we were down double digits at one point before the market recovered. I think that plays out next year, but for the reason that I previously stated, I think that we end up a bullish outcome despite all the skepticism. And it does require large cap tech and AI stocks to still produce earnings growth and not have a lot of PE reduction so that you still get positive return. But I think the rest of the stock market, so the other 490 or so, can actually perform well, because if the Fed is cutting and interest rates are coming down and the business cycle is sort of really starting, that's good for other stocks. Almost kind of mirroring what we're observing, but just with a different take. I mean, our take is markets climb a wall of worry. Historically, when there's a lot of skepticism, stocks can rise. In fact, markets actually peak on good news. They don't peak when people are bearish. Markets peak when everyone's bullish, and it no longer responds to good news. Just like markets bottom on bad news. And I think many people are skeptical, but stocks have risen. It doesn't really mean markets are shrugging off the concerns. That's one way to interpret it. My other interpretation is, there is a wall of skepticism. And I mean, maybe that's just it is like, maybe we're just talking about the same sides, just of the same thing. And, but, like if someone asked me, is it worrisome? I was a technology analyst in the 90s, so I covered wireless stocks starting in 93, and I witnessed the bubble that was created, a decade in the making, really 2 decades in the making. And by 99, not only was there no skepticism, there was excessive entitlement. Investors were expecting stocks to do explosively, and a 20% upside wasn't satisfactory, and valuations were already elevated and expanding. So I'd say that if I was trying to compare this to the bubble of the 90s, and wireless was a central cast character in that internet infrastructure build, where I don't really see the echoes of that today.
I think it's so interesting what you say there about, we're looking at the same things and we're drawing slightly different conclusions about what that means for markets. And we had a similar conversation with actually, you were the chief equity strategist at JP Morgan. We spoke with their head of investment strategy, Michael Semblist, and we were talking about a lot of these issues. And where he ultimately landed was he was quite bearish. And I just want to play you what he said and get your reaction, see what you think.
It would be kind of shocking if you didn't have some kind of profit-taking correction in 2026 at some point on the order of 10 to 15%. It would be, I'd be really surprised not to see that.
Our outlook actually does call for a drawdown. next year. So very similar to this year, of probably closer to 20%. So I think we are going to have another miniature bear market next year, but then we're going to recover. I mean, let's take 2025. Let's say that at the end of 2024, and actually we did talk about, the idea of a drawdown in 2025, but let's say that someone plays the clip. So let's say it's Michael Semblis, but let's just pretend he's saying at the end of 2024, and he says the market will be down 10 to 15%. That doesn't rule out where we are by the end of 2025, because in fact, we did have a drawdown. And I think I'm not, again, saying, I actually think Michael and I are pretty aligned in the sense that I think there is going to be a drawdown next year. He says he wouldn't be surprised. But to me, it doesn't mean that's the end of the actual bull market. And in fact, I think stocks fully recover.
Do the big tech companies, the Magnificent Seven, do they count in your analysis of AI valuations being too high and the possibility that perhaps we might lose out, or that the value won't actually show up for many of these companies?
A lot of the Mag 7 used to be asset-light businesses. The remarkable equity, sort of rent-seeking model of them was that they could create growth with very little spending. I mean, R&D spending was there, but really CapEx was not there. But today, as you know, AI is extremely capital intensive and it's energy intensive, and it's only justifiable if it's replacing real work somewhere else. Then you can justify, because now it's creating assets to replace future OpEx, I'm going to give you a spin about what's happening that is not disagreeing with what you're saying, but it's probably observing a change in the reality, okay? Which is, tech companies are becoming a bigger part of our life. So naturally, they're going to have a larger share of spending. By the way, we wrote about that in 2018, that if you go back to 1930 and you just use simple demography, okay, population tables, whenever the population growth rate grows faster than the prime age workforce, which means you have compounded labor deficit, you've always had a technology cycle. That was 1948 to 67 and 1991 to 99. In both of those periods, the population growth rate was growing fast, which is demand, faster than worker supply. And we entered the third epoch or era of labor shortage, which started in 2018 and it's going to last to 2035. So then technology spend is necessity because you don't have as much labor available, so there's going to be less wage spend.
Yeah.
Now, if I substituted the word and called this, instead of the word banks, tech companies, I called them financial institutions, we would not be saying there's a financial institution bubble, because for every unit of GDP growth, there's a unit of financial spend. I mean, it's literally the other part of the ledger. And in fact, the financial industry has all circular spending. I mean, think about this. Real estate is valued as a separate asset, but every company needs real estate just to run a business. So why are we valuing real estate? Like in a GDP sense, real estate should be an interim product, not a final product. So I think tech is becoming so central to the economy, especially because of labor shortage, that when we see tech intensity growing, people are flagging that as a bubble, whereas I'm actually just pointing out it's actually out of economic necessity. But it becomes a bubble if the multiple we're applying to the tech streams don't justify higher valuation. I think tech earnings are probably more valuable than Costco, for instance.
Yeah, agreed.
Or Walmart, right? But Walmart trades at 37 times forward earnings and Costco trades at 50 times. So Nvidia trading at 27. I mean, is there a bubble in Costco and Walmart because Nvidia's at 27 times earnings?
Therefore, it seems that we're making giant predictions with not that much evidence, which, we could call it a bubble, or we can just call it what I said, which is we don't really know what's happening, and yet we're spending tons of money. And so if there becomes a moment where suddenly everyone says, wasn't what we thought it was, then that could be quite damaging to portfolios.
Yeah, 100% agree. Because, by the way, anything that is relying on future growth, none of us is an expert on the future. I mean, that's right. Like that, there's many roads to the future. One thing I just want to point out, Benjamin Graham's book, The Intelligent Investor, which I did read. I don't know if you remembered his rule of thumb about what a proper PE is.
No, please.
It's 12 times plus 2 times the growth rate. That is in his book. I'm just saying, when someone says they're a value investor and they're saying stocks are expensive, I know they didn't read his book because I read the book.
I love that.
But, as you know, that's because he didn't believe things could grow 10% a year. That's the reality. Like 10% is a lot of growth back then.